Hello, today I'm going to talk about the Bethesda mining company. So we're going to discuss this case, and and in the end we're going to have the conclusion whether we should take this project or not. So this is a kind of a roadmap of what we'll be discussing over the period. There will be case explanation at the start. So I'm going to just explain a little bit theme of the case. Then we're going to calculate the NPV, net present value, the payback period, the internal rate of return, the profitability index, and then the conclusion. Right. So the case of the Bethesda Mining Company is very simple. They've been approached by an electric company to request for supply coal for their generators. So currently the company doesn't have excess capacity to guarantee the product, so they're considering to open up a new mine. But after completing with the project, they must reclaim the mine land, and it must be restored to its original condition. The company can buy additional product to increase the capacity, and the equipment is about almost of 43 million, and they can sell the product after 4 years at 60% of its initial price. So here, these are some of the values that we would be using in our project: 500,000 of coal at 60, 758, 10, 8, 37, 20 in 4 years. Excess production will be sort of 48, 21 per ton variable, and fixed cost 3.7 million, net working capital 5%, and cost of reclamation 3.9, 38% tax with a 12% required return on the spring mine project. So now we're going to start calculating the NPV. So the NPV shows the present value of the future generated cash flows. So to determine whether the project, we should be start working on the project or not, whether would it show positive cash flows or not. So currently it has, the way we're going to do it, it has 3 steps. First, we're going to calculate the calculation of the operating cash flow. Then we calculate the cash flow as a result of net working capital. We're also going to do the tax deduction, and then in the end, we're calculate the net cash flows. So in order to do the first step, the operating cash flows, we must find two major parts. The total sales, which in each year, and to calculate the depreciation according to MSCRS procedure. So you can see the total sales of the calculation. So tons produced are 750,000, 810, 830, and 720. So according to the question, they said that they are going to be required 500,000 of tons every year at a rate of 60. So when you multiply that with the value, you get 30 million on contract sale, and the above sale in the first year, it would be 250,000, which would be excess. If you multiply it with the 48 spot sale price, you get 12 million, and in total you get 42 million for the first year, and that is how the calculation has been done for the 4 years. Then we calculate the depreciation. The rates that you see, these rates have been provided by the IRS according to the MSCRS depreciation method. So they've been the equipment cost it's given here, it's 43 million. If you multiply it with every rate, you get the value 6.1 million, 10.10, 530, 700, and so our project it's only consists of 4 years, so we only need the ending value of year 4, which you can see here is 13.433200. So you can calculate this value by just subtracting all the year 1 to year 4 values from the 43 million, and you will get 13.433200. So now in the next slide, we're going to calculate we have done the calculation of the operating cash flows. You can see the total sales, which we have taken from the last slide. The depreciation we have taken from the last slide. The variable cost, so we calculated very simply with a 21 is the value, and if you multiply it with 750 of total ton, you just get the value. The fixed cost, they have been remain same, 3.7 million for 4 years. the depreciation as before. So when you less the values, just according to normal procedures, from the total sales, you less the cost, you get the profit before tax of 16.405, 300, 13,639, 300, and the rest are just the same. The tax as required by the question is 38%. We get the values. We less the tax from the profit, we get the net income. So in order to get the operating cash flow, we must add the depreciation back so we can get the operating cash flows. So we got all these operating cash flows. This is the calculation of the cash flow as a result of the net working capital. So here you can see the net working capital requirement is like the 5% of the next year's sales. So in the first year we got the sales of the 42 million in total. So if you take 5% of it, you get 2.1 million, and this is how all the sales have been calculated. Through year 4 it would be 0 because in year 5 we don't have any the sales or something. So increase in net working capital would be at the year 1, it would be like negative. So if you less the 2.1 million from the 2.244, you get 144, and then again if you less it from the other one, you get 48, and when you less it from the last one, you get the positive one, 264,000 of this one, and then in the end you get the positive for the year 4, you get the positive net working capital cash flow. So in this slide, we're doing the calculation of the tax deduction. The tax deduction actually plays a very important role here, because at the end of the year 4, in the year 5, when the company is gonna reclaim do the cost of the reclamation, it's gonna be considered under the charitable expense of 7.3 million. So they must deduct the tax from it, because if they face any kind of loss in their cash flows, they can use that tax credit to reduce their losses. So 7.3 million has been multiplied with 38%. So you can see we got 2.7 million almost of 74,000. So after tax salvage value, this is what we need to calculate. The formula is right given up here: pre-tax salvage value minus the pre-tax value minus the ending value multiplied by tax rate. So the pre-tax salvage value is 25.8 million. So in the question, they told us the equipment cost 43.43 million, and they can sell the equipment at the end of the year 4, and they can get the price of almost 60%. So this is the price that they would get if they sell the equipment after 4 years. The ending value, this is the value that we have calculated according to the depreciations method back in the last slides of 13.433. The depreciation we got at the end of the year 4. When you deduct the ending value from the pre-tax, we get 12.366800. We take the tax on 38% and we get 4.699384. We use the formula and we get 21,100,616, the after-tax salvage value. So this is the major last slide of the net cash for the net present value. So we have everything up here we're considering 5 years, because at the end of the 5 year we need the reclamation and the tax reduction. The main purpose of doing calculation is this: to find the net cash flow. We got the operating cash flows, the cash flows at the end of net working. Then we use the net cash flows to add it with the initial investments and calculate the net present value. So I have calculated the net present value through the calculator, but also I calculated through by this simple math techniques, and I got the same answer. So the payback period defines as whether have you invested in an asset and how much time will you get that money back. So the sooner you get your money back, the better it is. So we have for 5 years we have the net cash flows available, and we've done the cumulative cash flow. We just less the values each and every year, and we see where the cumulative cash flows goes from negative to positive. So in this case, from the second year to third year, the cash flows are going from negative to positive. So if we've taken 17,288, 948 at the numerator, and in denominator we take the net cash flow of 18.939 to get the 0.935. So since it's happening in the second year, we're gonna add the 2 into the answer so that we have an idea that it will take probably 3 years to get the investment back. So net present value shows at what point the present value of the cash flow will be zero. So in this case, the required return rate was 12%, whereas we got the IRR of 20.78. It's very easier to calculate. I calculated these values through the calculator from the BA2 plus calculator after calculating the net present value. If the IR exceeds the company's required rate of return, that means the project is desirable. So we got 1 point here that we should proceed with the project. So this is the last step, whether we should be continuing with our project or not. So it's a very simple profitability index thing. We add the NPV with the initial investment and just divide it with the initial investment. So we got the NPV of almost 11 million. We added with 52.4 million of the initial investment and we got 1.21. So mostly if it's higher than 1, that shows that you should proceed with your project. So in this case, we got 1.2. The conclusion is as simple as that we got the NPV in positive, we got the IRR more than the required return, and the probability index was 1.21. So we can say that we should accept the project. Thank you very much for listening to me. Hope you have a nice day.